20 real estate test questions that'll help you pass your real estate exam. This week's questions are related to finance. So before I dive into the questions, I will say these questions are brought to you by Calibri. So that's an online education platform that I used to pass my real estate exam and my loan officer license exam. Full disclosure, it's an affiliate link. So if you end up buying something, I do get a small amount of the purchase. So if you like these videos, thanks for supporting, and I hope you pass your exam on the first try. Let's get into questions. Question number 1. An alienation clause in a mortgage refers to the clause that A, says the entire mortgage is due if the owner moves outside the US. B, allows the lender to charge a penalty for early payment. C, allows the lender to call for full payment of the mortgage because the owner transferred ownership to another party. D, pledges the property as security to a third party. Correct answer here is C, allows the lender to call for full payment of the mortgage because the owner transferred ownership to another party. The alienation clause basically ensures the lender's control when ownership is transferred. This is also known as a due on sale clause. Question number 2. What type of note calls for interest payments during the term of the loan and principal due at the end of the loan? A, straight term loan. B, installment loan. C, amortized loan. D, balloon wraparound loan. Correct answer is A, straight term loan. So a straight term loan involves paying only the interest during the loan term and then a lump sum principal payment due at the very end. Question number 3. An investor decides to take money out of a savings account and invest it in corporate securities to obtain a higher yield. This movement is known as A, disintermediation, B, dedication, C, debt service, D, discrimination. The correct answer here is A, disintermediation. So this pretty much just means you're moving money out of low yield accounts like savings and moving it into higher investments. It's definitely not discrimination. Banks and investment firms are not going to discriminate when you put your money into their accounts. Question number 4. What is the temporary loan made on a borrower's equity in their present home? A, package loan. B, balloon payment loan. C, blanket loan. D, swing loan. The correct answer here is D, swing loan. So swing loans are more commonly known as bridge loans. And these allow borrowers to use the equity in their current home to go ahead and buy a new one before selling that old one. Question number 5. Notice of default must be executed before notice of sale is given. How long before notice of sale must this occur? A, 6 months. B, 10 days. C, 3 months. D, 2 months. The answer is C, 3 months. So notice of default must be recorded and given at least 3 months before issuing a notice of sale. Question number 6. The note that calls for periodic payments on the principal and a balloon payment at the end is called A, a straight note. B, adjustable rate note. C, fully amortized installment note. D, partially amortized installment note. Correct answer here is D, partially amortized installment note. So if you remember, a straight note, that's just interest. Adjustable rate note, that means the rate is adjustable. See, a fully amortized installment note means that every monthly payment you're paying off principal and interest. So at the end, there's not going to be like a lump sum payment towards principal, and that just leaves us with answer D. Right? You're going to periodically make principal payments, and then the remaining balance of the principal will be due at the very end. Question number 7. RESPA regulations would not apply to which of the following? A, first lien residential mortgages. B, the second or subordinate lien for home equity loans. C, a transaction financed solely by a purchase money mortgage taken by a seller. D, 1 family to 4 family loans. Correct answer here is C, a transaction financed solely by a purchase money mortgage taken by a seller. So what this means is that the seller actually financed the purchase. So this would be considered a private arrangement between the seller and the buyer, and RESPA does not cover those types of things. And to go back to this one, right? So If you didn't know, a seller can actually sell their home and they can become the bank. They can do what's called seller financing. If they don't own, if there's no debt on the property or the debt is paid off through a down payment, sellers do have the right to become the bank when they sell their home. Question number 8. The term debt service refers to A, an instrument used in place of a mortgage, B, the amount of money paid in regular intervals to reduce the balance owed on a debt, C, the movement of money out of a savings account into higher yield investment, D, the amount of money owing on a note or promise to pay. Correct answer here is B, the amount of money paid in regular intervals to reduce the balance owed on a debt. That's all the debt service is. Question number 9. In return for beneficial loan terms, a borrower may obtain a type of loan where the lender shares the property's appreciated value. This loan is called A, graduated payment adjustable mortgage, B, shared appreciation mortgage, C, variable or adjustable rate mortgage, D, rollover mortgage. Correct answer here is shared appreciation mortgage. So, shared appreciation mortgages allow lenders to share in the future appreciation of the property. A good example of this one is if you're in California, you might have heard of the California Dream for All. And so that program actually was a shared appreciation mortgage. These shared appreciation programs are often seen in down payment assistance programs. So some real estate professionals they actually advise their clients to stay away from these types of programs, but some of them are a great way for people without a down payment to get into a home. Question number 10. When a trust deed debtor is in default, the loan may be reinstated if all delinquencies and fees are paid prior to how many days before a trustee sale? A, 10 days, B, 3 days, C, 5 days, D, 7 days. Correct answer is C, 5 days. So borrowers have until 5 days before the trustee sale to reinstate the loan by paying all amounts due. Okay, so we're halfway through 20 questions. We just finished question number 10. I make these videos to help people get their real estate license, and I want to see people do well in their real estate career. So I have created a weekly newsletter that shares the mistakes that I've made, tips for real estate agents to generate more business, and just share some of my experiences as a real estate agent. If you'd like to get that weekly email, go ahead. There's a link in the description here, and you can just sign up to get those weekly emails. All right, back to the questions. Question number 11. A provision of a promissory note or mortgage where upon the happening of a certain event, for example, default, the entire unpaid balance becomes due immediately is known as A, inchoate clause, B, habendum clause, C, indemnification clause, D, acceleration clause. The answer here is D, acceleration clause. So this basically just allows the lender to require immediate repayment of the entire loan balance if specific conditions are met. Question number 12. RESPA requirements would not apply in which of the following situations? A, when the property mortgage is insured by FHA. B, to a conventional loan that would not be sold on secondary mortgage markets. C, when property is purchased with a federally related mortgage loan. D, when the property mortgage is guaranteed by VA. Correct answer here is B, to a conventional loan that would not be sold on the secondary mortgage markets. Question number 13. A type of financing for real estate mortgages where the annual percentage rate varies year to year based on lender specific terms is known as A, adjustable rate mortgage, B, amortized loan, C, fluctuating loan, D, fixed rate mortgage. Correct answer here is A, adjustable rate mortgage. Just in the name of an adjustable rate mortgage, you know that something's changing, right? Because it's adjustable. And so these adjustable rate mortgages, also known as ARMs, they have an interest rate that adjusts periodically based on the terms of that loan and the market conditions. Question number 14. The note that calls for the payment of interest only is called A, straight note, B, fully amortized installment note, C, partially amortized installment note, D, adjustable note. Correct answer here is A, straight note. So we kind of went over the other definitions in the past. Adjustable means that it's going to change. Fully amortized installment note means that you're paying principal and interest every month. Partially amortized means you're paying some principal and some interest every month. So When you're studying, make sure you know what these different loan types are, the definitions of these words, and these questions are going to be a slam dunk. They're going to be easy for you. Question number 15. The note in which the interest rate varies upward or downward over the term of the loan is called A, adjustable rate note, B, fully amortized installment note, C, straight note, D, partially amortized installment note. Correct answer here is A, adjustable rate note. Question number 16. The law that requires a lender to disclose the cost of getting a loan is A, truth in lending, B, RESPA, C, FHA, D, caveat emptor. Correct answer here is A, truth in lending. So, the Truth in Lending Act mandates that lenders disclose all loan costs, including interest rate and finance charges. So, when you are studying, make sure that you know what the Truth in Lending Act is. Make sure you know what RESPA is. Make sure you understand how these different laws and regulations impact the consumers and how consumers are being protected by these laws. Question number 17. A partially amortized note that reduces part of the principal by the time the final payment is due is often called A, a conventional loan, B, a wraparound mortgage, C, balloon payment / balloon note, D, fully amortized loan. Correct answer here is C, balloon payment and balloon note. Once again, you just need to understand what types of loans are out there, the features of those loans, definitions of these words, and you will crush your exam. The buyer agrees to purchase real property by making monthly payments to the seller and then receiving a deed at a later point in time. This agreement is known as A, land installment contract, B, construction loan, C, certificate of sale, D, straight term mortgage. Correct answer here is A, land installment contract. So, land installment contracts involve regular payments to the seller with the deed transferred after the full purchase price is paid. Question number 19. Net income can be defined as A, income after expenses, B, effective gross income, C, potential gross income, and D, total of all income. Correct answer here is A, income after expenses. So if you just understand the basic net income calculation, this question's easy for you. Question number 20. A lender wishes to make the yield on a lower than market interest rate loan competitive with higher interest rate loans. What would the lender charge to make the loan competitive? A, penalty points, B, discount points, C, debt service, D, deed in lieu of foreclosure. Correct answer here is discount points. Discount points are charged up front to increase the lender's effective yield on a loan with below market interest rates. So that's 20 real estate questions related to finance that you'll probably see on your real estate exam. So I hope you enjoyed studying. If you need anything, feel free to email me.